CN Rail, that stock has suffered over the past year. It's down about 18%, and investors probably won't like the latest numbers from the company. It just reported its latest quarter, but it is cutting its estimate for earnings per share growth this year. Let's get more from Steve Hansen, Managing Director and Equity Analyst at Raymond James. Steve, thanks very much for coming on. Can you tell us what jumps out for you with this forecast reduction at CN Rail?
Yeah, I could be with you, Annie. Thanks for the time. Look, I think in many respects, this had been somewhat expected coming into the quarter. Just as a reminder, traffic has been tough for the carrier for a period of time here. We've had a lot of macro volatility out there, no surprise with the trade tariffs. They've had a couple of categories that have worked in their favor, like grain, but the bulk of the rest of the economically sensitive business, frankly, has been pretty weak. So in that context, the quarter was roughly in line, but they actually did cut the guide, as you suggested. I think that's being conservative, really, until we know some better clarity of what happens for the back half.
And then they're totally removing, as far as I can see, their 2024, 2026 forecast, citing uncertainty over tariffs.
Yeah, that's exactly right. Yeah, and until we get some better clarity on this broader macro picture, I think that's probably the prudent thing to do here. I would say that traffic actually ran a little bit better than expected through Q2. They'd expected a deeper trough from some of the tariff-related impact, particularly for that inbound traffic that's coming into the West Coast here where I am. That proved to be a little bit better than expected, but there's still a great deal of uncertainty out there around these tariffs. And so until that opens up, I think that's probably a prudent call.
Is there a particular part of their business? I mean, they're in petroleum and chemicals, metals and minerals, forest, intermodal, etc., grain. But is there a particular part of their business that's very vulnerable to the tariffs?
Yeah, I'd say the most sensitive category would really be the international intermodal. So this is volumes that are coming in from China. It's consumer sensitive traffic, of course. So in the context that there is an impact on the consumer here domestically, that can have some negative draw. But the bigger issue is just how much volume comes from overseas versus other markets. And so that's where we've seen the biggest impact in sort of these windows that have opened and closed again around volatility in traffic. And that makes it hard to plan if you're a railroad moving a lot of large fixed cost assets. But I think from a broader context, as this settles down, we're starting to see some trade patterns fixed, if you will, or in the context of some trade deals being signed. And as long as we get improved sort of traction on that front, I think it probably gets less worse from here.
You think it doesn't get much worse? Sorry, Steve.
Yeah, that's right. Yeah, I call it less worse, which is like saying it's getting a little bit better slowly. But I say slowly intentionally. We've got a better outlook for the back half of the year than the first half.
Now, CN Rail stock as of today down about 19% in a year. CP down about 7%. Why has CP tended to hold up better?
Yeah, great question. I think it's really just sort of a combination of two things. One is CP has the benefits of much better traffic growth. You might recall they did a big merger just over a year and a half ago now with KCS. And so that's allowing them or affording them additional traffic growth opportunities that are not afforded to CN at this point. It's really more of a north-south story now where they really connect all the way down into Mexico, and they're adding new services around that. That's helped them a lot. The second part of it is operational and execution, and this is where CP is just continuing to demonstrate that they're really the standout performer, executing superbly almost in any traffic environment. CN is always been a good performer, but they have stumbled a couple of times in the last year and a half.
And just finally, Steve, there was talk of possible yet more rail merger activity in the States. Maybe Union Pacific would take a run at one of its rivals. I was kind of amazed. I thought that CP Kansas City merger was going to be the last allowed in the rail industry.
Yeah, indeed. Yeah, this is taking up virtually all my time this week and much of last week, frankly. Look, you're absolutely right. So for viewers' context, there's really, in the U.S., there is no ability to go completely from one coast to the other coast. You have to change carriers along the way. And so the concept is to allow, or the goal for the carriers there would be to merge so you can have a single line haul service effectively from LA to New York. Today, you have to switch off and hand off to somebody else. We have that in Canada, of course. CN can go from West Coast to East Coast, CP can go West Coast, East Coast, but that does not exist in the U.S. And so there would be a great deal of synergies around that kind of concept. However, the regulatory burden is significant and I would say even fierce. The KCS deal that was done by CP, we mentioned, was done on what we call the old merger rules. It was a much lower hurdle for a smaller player like Kansas City.
Yeah.
These bigger carriers are huge. And so the new merger rules are much more difficult to get across the line. So the thesis is we can try right now. The Trump administration might be the one administration to let these things go. And I think that's why everyone's arming up with bankers and, their own strategy rooms. But I still struggle to think that one will get done, frankly.